Okay, hello. Welcome to Mtrading's webinar. This is our end of year webinar, so we are going to cover the biggest stories of 2017. So if there are things that you are not aware of, that is what we're going to cover. We're going to cover all the major high impact news and events that have taken place in the year 2017. So I'm your market analyst, Gavin Pannu. So let's start. So the first thing I want to make clear is that this year has been a very great year for trading. Yep, so it's been a great year for trading. It's been a very eventful year. So it has been driven with a lot of macroeconomics. Yep, so I would say it has been more technicals and more macroeconomic driven rather than the longer term fundamentals that have had an impact on the markets. Macroeconomics or macro-driven news is short-term themes that are taking place in the markets. So I'm going to cover 6 major themes. So 6 major themes that has had a significant impact in the markets. Okay, number 1, Brexit. Brexit's been the top theme of 2017. So since, as you can see, we're looking at a cable chart. So GBP USD over here. So GBP USD, we're looking at the daily time frame. We're starting our analysis from this point here. So the beginning of this year. So the beginning of this year. Prior to that, you can see a significant downtrend overall. Yep. And we had, this will be your Brexit. That was your initial Brexit, some sideways action taking place, and then a further depreciation in the asset price. Almost, and this last final piece over here was a flash crash in this particular asset. Yep, which actually dropped down to way below the 118 level. But it was stopped, it had held its trading for that eventful period. So since then, we've hit these lows, we've hit these significant lows, and we've been in the negotiation phase. Yep, so we've been, there's been a referendum, so a referendum taking place in the UK. In addition to that, we had more negotiations taking place with the European Central Bank, so the European Union, along with the UK Parliament. Yep, and only till now and recently, they have concluded that they are past the negotiation stage, yep, which led to a significant drive in this market higher. Yep. So all the way through, it has been bullish, but as you can see, look at the volatility from the lows to the highs. We have some significant volatility, especially in the most recent price action. The only reason we're still below this level here, so still below the 136 handle, that is purely because we're now in phase 2 of the negotiations. So phase 1 was the hardest part, whether it's going to be a soft Brexit or a hard Brexit, and the negotiations that were taking place. But now they have come to an agreement. Now it's about the finer details. So the finer details, which is the phase 2 of the negotiation, which may be more difficult than the phase 1. So there have been recent outbursts from ECB members who have mentioned that phase 2 may be more difficult. So there is still a long way to go with this particular asset in regards to Brexit. I would say be aware of the Brexit scenario. We are coming towards the end of Brexit, but it is still highly relevant going into 2018. Yep, so be aware of Brexit. We're looking for the break through the previous highs for the long-term push higher. Once we break through this high, we're clear. We are clear of that initial sell-off that took place when we found out that Brexit was taking place. Yep, and this was June the 23rd. So June the 23rd, we had a significant sell-off on Brexit night, and we are on our way to recover from that point onwards. Yep. So look out for any high impact news and any more negotiations on the second phase, which could have an impact in this particular asset. So yes, number 1 has been Brexit. The key markets to focus on is the euro and sterling. Okay, so number 2. So let's move on to our next point. So the next biggest story of 2017, which is Brent. Yep. So the oil market overall. So let's have let's zoom out, look at the bigger time frame. Similar to Brexit, so similar to Brexit, we saw a significant bear market. And have a look at this sell-off, guys. Having a look at the sell-off from these 113 levels, 113, 116 levels, a significant drop, and it's almost just a falling market taking place all the way down to the range of the 50 level. So it fell all the way to the 50 level. From there, you had a dead cat bounce. So some rallying taking place till we have the next significant sell-off getting down to these lows. Yep. So again, a similar scenario with Brexit, but more positivity, to be fair. There is more positivity. So we had the first OPEC meeting which took place earlier on in this year. So you have two OPEC meetings taking place a year. We had the first one taking place earlier on in this year, and that was very positive of a output freeze. Just recently, November the 28th and the 29th, where OPEC members and non-OPEC members got together, and they have decided for a further output freeze, which led to this significant drive higher. So we've seen a significant drive higher taking place. So we are almost recovering back to a stable price. So the stable price will be this midway point. We are looking between the 65 to 70 range. Yep, so have a look, as this is your next key level. This 71, 70 level is your next level of resistance. So be aware of this. But we are seeing a nice incline. So we are seeing recovery taking place, especially that we have now confirmation from OPEC and non-OPEC members of a further output freeze going into 2018. So we're seeing more bullish scenarios taking place in the oil market. But this has been very relevant for 2017, guys. Okay, let's move on from there, guys. So the next one that I'll be looking for is quite specific now. So it's more of a geopolitical concern. So we're looking at market risk. So how much market risk has there been in 2017? I would say significant. There's been significant market risk, and that's from geopolitical concerns, mostly geopolitical concerns. Geopolitical generally means it could be countries, governments, those types of themes are playing out more relevant in the markets currently. So the first one would be Trump. Trump has been very vocal in his views in regards to the way he wants to go about things. Yep, so specifically we're talking about North Korea also. Yep, so Trump, North Korea has shown that they have missiles that they are willing to use, and they have used them over and have flown missiles over Japan. So there is a significant geopolitical concern there between Trump and North Korea. Yep, that's the first key point. And North Korea are showing concern for South Korea, so be aware of that. Yep. In addition to that, you do have a new Fed chair member who will be stepping in the coming months, so early 2018. So Janet Yellen has been in the middle ground. She was very on the fence rather than very focused in regards to being hawkish or dovish. What we're seeing now, the new Fed chair may be more hawkish. Yep, so we're seeing Powell stepping in, and he has generally been more hawkish in regards to the way they set their monetary and fiscal policies. Yep. Okay, but to refer back to a key point here now, so I want to refer this back to a key point, which is I have something for you guys to just have a quick look at. So how much does this have? How much has this had an impact on the financial markets? Not so much. So we would have assumed that, yes, on the intraday and a day-to-day basis, we've seen risk on and risk off scenario. So 1 minute we're seeing it's very positive, which is seen as risk on, and then the next minute there's been missiles flown over into the sea, and that has caused a risk off scenario. So everyone moves their money from stocks into more safe havens, so bonds and precious metals. But if we look at the 1 year performance, we're looking at a global 1 year performance of what has been the return, we'd all assume that yes, the US equities have done really well. We're seeing a 21% gain. But if you compare that to countries such as South Korea, So South Korea, even with the threat of North Korea, they have returned 40%. So over 40% return, one of the highest returns. So they've been in the top 5 performance for this year. So I wouldn't say on a longer term view that the geopolitical concern is causing market risk. It is seen as more of an intraday, day-to-day focus that geopolitical concerns are having a market risk. So those will impact day traders mostly, not those swing and those longer term position traders or investors. Okay. In addition to that, yes, what has the equities market done overall? Just by looking at all of these countries, we can see they're all positive. So this year has been a very bullish year. It's been a very positive year. So the highest return has been in Argentina at 56%. Yep. And then we're seeing India, China, South Korea. We're looking at Poland, Austria, Germany, France have all shown very strong gains, but all the other major countries, so you got the United States, Canada, Mexico, Australia, the United Kingdom, they've all shown positive gain. So yes, this year has been a very bullish year. So it's been a very bullish year. Have a look at all the indices. So have a look at the Dow Jones hitting new highs every week, not just every month, but every week we're seeing new highs in, there's only been a few weeks where they haven't gone on to hit new highs. But overall, Dow Jones, the Nasdaq, the S&P 500 have all gone on to hit new highs. Yep. So yes, there is a market risk with geopolitical concerns, but I would say it's more for intraday and day-to-day trading that it has an impact on. Whether if you're longer term and more of a position trader, then you are still okay with the overall market conditions, which leads me on to my next point, the economic financial conditions. So over 2017, the economic conditions have been, in my view, been overall positive. We've seen a very positive outlook. So from where we've seen a significant drop in interest rates, so overall we've seen every single major economic powerhouse has reduced interest rates. In 2017, they've either kept it stable or they've increased interest rates. In particular, the US has increased their interest rates a number of times. So we are starting to see a significant recovery and more of a bullish scene going into 2018. Just to give you proof of that, have a look at this, guys. So this is probably the worst chart that I could show you in regards to positivity. So this is the ECB. So the ECB have kept their rates at 0%. So they kept their rates at 0%, but the positive side to it is they have reduced their quantitative easing program. So they've reduced the amount of money that they're producing and supplying. Yep. So that is seen as still positive. So yes, the ECB have been positive, but they still are very cautious. Yep. So that's the first point. Next one we'll have a look at is for the Bank of England. So the Bank of England has, in 2017, most of the year kept it stable. So kept it stable, and the reason why they've kept this stable is due to that Brexit concern. Only from the recent positive negotiations that have taken place, we've seen a rate hike taking place to 0.5%, so 0.5%. Yep, so there's some positivity there. And finally, let's move on to the last chart over here, which is the US. So as you can see, the US in 2017 has incrementally increased their interest rate on a regular basis. Yep, so we have seen a rise in the interest rates. We are at 1.5%. According to how we were prior to the recession of 2008, you can see we're way off. So overall, this is also very positive for the financial conditions of the market. We are likely to see further positivity going into 2018. So if you're assuming that, nope, these are the highs, I would say it's way too early for that. Also remember, during this period, during this winter period, there is a thing called Santa Rally. So you generally see people are extremely optimistic. They are spending more money in regards to buying presents, going out for meals. So this is seen as a very optimistic period. So we are likely to see a continuation of a rise in the markets going into 2018 and at the beginning of 2018. Yep. Okay, so let's move on from there. Right, so a next key point I wanted to mention, which is now focusing on individual equities. So I want to be focusing on individual equities, which will be the tech sector. So the tech sector has shown the biggest returns in equities. So the equities, the sector itself is the tech sector. In particular, the acronym known as FANG. So F-A-A-N-G. So that's a double A there. Yeah. So that stands for Facebook, Amazon, Apple, Netflix, and Google. Each of these companies have shown the largest return in regards to being one of the top 100 companies. Yep, so top 100 companies there. So just to have a quick look through. So looking at the daily chart. So looking at the daily chart on a longer term basis at the beginning. So at the beginning from the bottom we're seeing at around the 112 to 116 level. We are at 178 currently. So an extremely positive outlook there in regards to Facebook. We also have Apple. So let's just zoom out also. So again, the beginning of the year, so we're seeing the beginning of the year, around the 107 levels, we are at the 174, a significant rise there. And Amazon's hitting that key level, guys. So it's hit that key level of the 1,000. It's broke through impulsively, and we're staying above the 1,000 level. So again, we're seeing another bullish rise from the 700 levels, from the 700 to 710 level. We're seeing a significant rise all up to the 112 level, so $1,200 level. Yeah, and then finally we have Netflix. Let's just zoom in. Okay, so Netflix from the start of the year has shown a very positive return. Yep, and then as you can see, let's move on to Google. So Google has also broke through that 1,000 level barrier, so 1,000 barrier mark, and that has gone on from the lows. Let's have a look at the lows being in the range of this point over here, so around the 750 level. So around the 750 level, we've seen a significant bullish move up to the 1,073 level there. Yep. So if you was invested in the tech sector overall, you would have done very well. It's been very positive, and yes, that is where I'd be invested currently. But going into 2018, this could be the time where you start to take some profits. So do look to take profits in the tech sector. That is extremely important. Yep. Now, my final piece for the 2017 review is a new asset class. There is a new asset class which is known as cryptocurrency. So cryptocurrency, in particular Bitcoin. So Bitcoin is the leader in cryptocurrency, and that has provided the largest return of any asset. Just to give you an example of Bitcoin. So this is a chart of Bitcoin. Yeah. So looking at from where we have started, so we are looking at this key point here. So this is the 2017 price level. You can see the lowest it was at. It was around the 700 to 750 level, and we've seen it rise to a significant, almost respecting the 20,000 level. So it's gone on to hit the 20,000 level. So a couple of key points I would want to mention in particular with cryptocurrency. Remember, this is a new asset class. Only last week, so last week Monday, it was listed by the CBOE. Yep. So it was listed by the CBOE, and then it's been listed yesterday, Monday, the 18th, on the CME, so Chicago Mercantile Exchange. So this will allow all the professional investors to be able to trade this asset, and you can trade it as a futures, trade it as a derivative, or an option. You can also go to external exchanges you can use external exchanges which are not as regulated as the CME and the CBOE. Yep, so there is less regulations in this particular asset class. A key point I'd want to also mention is that this is based on a blockchain technology. So it's based on a blockchain technology, but the way that we have seen the rise taking place in cryptocurrency and the amount of investors that are buying into this asset, and there isn't as of yet, only from yesterday, that you could short this market. So there wasn't a way to short this market and professional investors to get into this market. So we've seen a speculative bubble taking place. There is some risk concerned here, guys. So do take caution. If you are investing in cryptocurrency, do risk with money you can afford to lose and not bet your house on this. It is extremely important. It is very speculative at the moment. This is similar to what is known as the first recession, the first speculative bubble, which was known as tulip mania. If you have not heard of tulip mania, do some research. This was many years ago, and this asset class, Bitcoin, has followed that same price structure as what took place in tulip mania, and there is some caution that by February we could see a significant correction, if not a significant crash in this asset. So that is a warning from myself, guys. There is high risk involved. It requires significant leverage, the spreads are extremely wide, and there is a lot of volatility. So be cautious investing or trading cryptocurrency. Yep, and that covers my end of year review, guys. So that was the biggest stories. We've covered Brexit, oil market risk with geopolitical concern. We've gone into economic financial conditions, and then we've gone into what has been the most popular sector, which has been the tech sector, and in particular the FANG stocks, and a new asset class known as cryptocurrency. This is the end of year webinar, guys, so please do give us more information, reviews in regards to what you want us to bring out and bring to you guys in the new year. But anyways, so if you Merry Christmas, guys. If you do not celebrate Christmas, have a good winter break and a Happy New Year. Take care. Bye-bye.